Okay, good morning, everybody. We'll keep this moving along real quick with the small cap panel. My name's Dave Judice, and I head up the intermediary sales national accounts team here at Barron. I'm going to just warm us up with a couple of questions to the PMs, and then we'll take your questions. But maybe I'll get started by asking them just for a quick, brief introduction. Maybe we'll just start at the end. If Laird, you wouldn't mind, just a quick, brief intro of who everybody is up here.
Sure. Laird Bieger, co-manager of Barron Discovery Fund.
Randy Gwirtzman, co-manager, Barron Discovery Fund.
I'm Cliff Greenberg, the co-manager or the manager of the Barron Small Cap Fund and the co-CIO of Barron Capital.
David Goldsmith, I'm the assistant portfolio manager for the Barron Small Cap Fund. I've been at Barron since 2006.
Thanks, guys. So to get us started, I thought it might make sense to ask Cliff to kick us off with how's the small cap, how's the market doing this year? How's the fund doing this year? If you could start us off with that, that'd be great.
Sure. Well, first of all, thank you all for attending. I've been managing this fund for 25 years, and I know many people have invested in it for a long period of time, and I want to thank you very much for your confidence in us and for coming here today to hear what's going on. To Dave's question, this has been kind of a pretty volatile year in the markets and for the small cap space. The market started off pretty well early in the year based on kind of recovery from last year's real poor performance. Stocks were kind of oversold. The economy was doing well, and everyone thought we were about to head into a recession, and the market and the economy proved more resilient than that. And so therefore, as business conditions held together pretty well, and it felt like we were getting close to the end of the Fed raising interest rates, the stock market actually acted very well, as did small caps. Starting in kind of August, the sentiment has changed, in which though the economy continues to do well, the Federal Reserve is out kind of saying that we'll keep interest rates higher for longer. There's new concern about the deficit, which may keep interest rates at higher rates for an extended period of time. There's terrible geopolitical conflicts around the world that make everybody anxious, and therefore, and the economy is definitely softening. So for the last month or two, the market has performed poorly, and we've given back much of the gains from earlier in the year. Our fund, the Barron Small Cap Fund, is actually having a very good year, especially on a relative basis. We're up 7 or 8% coming into this year, into today, and against our index, which is down for the year. Our good performance is driven by the fact that we have a handful of our largest positions have had great years in their businesses, and their stocks have followed them. A couple to call out: Vertiv, which is a supplier of products that will benefit as AI is brought into data centers. The company's fundamentals have been fantastic, and the stock has more than doubled year to date. Gartner stock, the business is terrific. IBP business is held in. Kinsale, who spoke earlier today, is having a sensational year. And our fund basically has been buoyed by the fact that a handful of our largest positions, the stocks have been very strong because business has been great. Unfortunately, that's offset by the fact that some of our companies haven't performed as well. Those stocks are lower, especially the small cap, the smallest companies. If you are to, in essence, stub your toe, or if there isn't liquidity in those names, the stocks have been incredibly volatile to the downside, which will be an opportunity go forward. But in general, the fund is, in my mind, is doing well this year, and we're optimistic about returns go forward.
Thanks, Cliff. Randy.
Yep, I'd echo what Cliff had just said about the volatility. Barron Discovery Fund is to date up a little bit against on an absolute basis, and we're about 3% ahead of the index. As Cliff said, the smaller companies are performing worse, and it's a combination of basically fear, less liquidity in these names, as everybody knows. And there's also this sort of overlay of ETFs and funds that, or investors that kind of use ETFs as a way to get in and out of small cap growth stocks on a wide basis, as opposed to trading individual stocks. That's one of the reasons I think that it'll be very interesting going forward as the market does recover, and these, the higher quality names, which Laird and I and Cliff and David invest in, start doing better. What we saw, just real quick, at the beginning of the year, we were positioned to be underweight healthcare, and healthcare has really underperformed for a number of reasons, but it was viewed as a safe sector coming out of last year, generally secular growth, but a number of factors have really hurt healthcare, including GLP-1s, these weight loss drugs that people know about. But on the other hand, coming into this year, tech, in particular software, was very undervalued, and we were overweight tech, and we remain overweight tech because we believe there's just some incredible values there, and those have performed really well. Our best performing stocks have been, one is a defense company called Kratos, which is a very interesting company that makes drones and satellite communications software. And then another company, DraftKings, which people have probably heard about, which is online betting. So, those are great secular growth stories, and there's a lot of value to be found, particularly in what Cliff taught us is about fallen angels, companies that are really good quality companies that maybe stub their toe, or in a bad market like this, they just get beaten down. Those are the ones, that's what we're spending our time on, and finding these great values.
Awesome, thank you. I just want to mention, we talked about year-to-date a little bit. Long term, the small cap fund, since inception, outperformed by about 400 basis points, and Discovery about 472, I think it is, as of 9:30. So just want to give you guys all kudos on that. And also congrats to you guys for your 10-year anniversary.
Thanks.
Congrats.
Thank you.
I'll keep it moving with maybe David, you want to go, we talked a little bit year to date. What about outlook go forward for small caps and the fund?
Yeah, thanks, David. We've discussed this a little bit. The Russell 2000 has been in a bear market for 3 years now. This is one of the longest ongoing streaks of underperformance versus large cap stocks. So where does that leave us? That leaves us historically low relative valuation versus large cap, the 7th percentile. And then historically, small caps versus their own average valuations are at much lower levels on any metric, but one is on a price to earnings ratio. The average small cap usually trades at 18 times, it's now 12 times. So again, it makes sense. Into recessions, small cap leads us on the down, and on the way out of recession, small cap leads us on the way up. Over the past 11 recessions, small cap has outperformed in each looking past the recession over 12 months, each of the last 11 times on an average of 16.5%. And so what that means is I think we'll start to see more attention to our names. Our companies are doing well, they're growing, and they are now relatively cheap in valuation. And so successful investing is having people agree with you later. And so as people gravitate more to this space, they will certainly look more to our names. And how we typically make our returns are the growing aspects of our businesses. Typically 15 to 20% of our businesses are growing. When you layer on that compound effect of a multiple expansion, I think the small cap space, and especially our portfolio, is set up to do well over time. And then just active management, we think, is the way to play in small cap. In each of the last 5 out of the last 6 years, being an active manager in small cap versus large cap has outperformed, and that's been the case in the last 2 years as well.
Thanks, David.
Yeah.
Yeah, just last thing, which is if you're a Barron investor, chances are you're a contrarian, and you also think long term. Well, as you've seen from our results, this hasn't been the time to be in small cap growth if you're looking in the rearview mirror. But the good news is as we think about over the next couple of years, I always tell our analysts when they're looking down or companies missed earnings that the good news is 100% of economic downturns are followed by economic recoveries. So things will get better. And coming out of this, as David was saying, small cap will lead. We ran an analysis and we were looking at past periods where small cap, as David said, typically underperforms coming in, but outperforms coming out. And so a couple of statistics coming out of the dot-com bubble. If we were to look at the 2 years after stocks bottomed back in 2003, what we saw is that the Russell 2000 growth was up 76% and the S&P was up 50%. So outperformed by 26 percentage points. Same thing with the Great Recession. If you look at coming out, the 2 years coming out of that, the Russell 2000 growth was up 146% and the S&P was up 103%. So COVID, same kind of statistics. We see significant outperformance. And so while we have not shown our best efforts in 2023 as a category, we do know that over the next couple of years, we really are going to have a period where we can shine and really show you how hard we've been working, because that hasn't come through yet, at least in nominal performance.
Great. All right, appreciate everyone's optimism go forward. I'm going to pause now and see if there's any questions. I know a few folks on my team have mics in the audience. I see Jennifer Wayne has a question, I think. So we're going to go to the mic by Wayne. Yes.
Hi, good morning. My question is for Randy, actually. It's a two-part question. Do you find that it's difficult having the constraint of only being able to invest in small caps and finding success stories? And I know that you've been modeling stocks since you're 9 years old. If you had one factor that you could put your finger on to say, this company is going to be successful, could you share that with us?
Yeah, thanks. It's Tom, right? Is that Tom? It is. So what is good about investing in small caps when there's so much else to offer? Well, these are companies that, as Laird and I say, you never heard of them, but you will. You hope to get the next Apple, the next tiger by the tail. And there's so many exciting growth stories. We own a company called Indie Semiconductor, which makes mixed signal semiconductors for the auto industry. And this company, they just reported last night, and they actually blew out numbers, which was, pretty exciting. And their backlog's up from $4 billion to $6 billion for a little billion-dollar market cap company. There's tons of companies like that out there. And if, so I won't get too deep into it, but that's sort of an example. We are never at a lack of opportunity for finding great new small cap ideas. The second part of your question, if I could put my finger on something that is exciting about each of these small cap companies that we like, it's really the management. Obviously the businesses have to be exciting businesses with big opportunities. But if you don't have a great management team that can execute and that you trust, and that last part is really important, then it doesn't work. And so that's what we strive to find in every company we invest in.
Scott, you have a question? Yep.
Yes, question about the liquidity of the portfolios between the small cap fund, a little over $4 billion, Discovery Fund, $1 billion. You may have some separate accounts in those same strategies. Wondering how you, how do you think about the capacity of the fund? And when you work with your traders, do you have a limit? Are they trying to stay under, let's say, 10% of the average daily trading volume when trying to get in or out of a stock, so you're not pushing it around?
Liquidity is less of an issue for the small cap fund than maybe you would think, primarily because the turnover of the fund is very, very modest, meaning it's about 15% a year, which means we, on average, own stocks for 7 years. So therefore, and our approach is not to be trading in and out of those names, but it is to, when we find something that we really like, to stay invested in it for the long term. We might moderate the position size, but to stay involved. So we're not, like most other small cap funds have turnover over 100%, and therefore they need to continue to find new ideas and sell the ones they own to replace them with others. We don't really have to deal with that. And then going in, we're going to buy 5 or 10 new stocks a year. An average position in a $4 billion fund is 1%, $40 million. That's not I can't snap my fingers and do that, but you're having done this for a long time, we're pros at being able to assemble that position at what I think is the right time, and that's not that much of an issue. And when we change our view on something and want to sell it, Usually, again, it's not a major chore to get out of those names. So, and as far as capacity is concerned, the fund at peak was close to $6 billion. It's $4-ish billion now. We own 70 names. If I ran much more money, we ran more money than present. What that would basically mean is that we'd need to own just more of the same names we presently own. We wouldn't need to go out and buy 20 new names if we had more money. And so that means if I own 40 million of a stock, I'll now own 50 million of it. That's not kind of the end of the world to try to build into that position or to sell out of that position. So therefore, because of the way we approach this, we can't put our finger on what the actual asset level of the fund is that's optimum or too big, but it's really not a challenge. We wouldn't change how we run the fund if we had a bigger asset base.
I would say we also, our fund has names that are a little smaller, but not typically microcaps that are, not traded well. And we take advantage of liquidity when there's an event, when there's a high volume on, say, an earnings event, upward or downward, where people are overvaluing the stock, we might trim a little, or if there's a bad result, there's typically also, if you lose your thesis and you want to sell the company, there's liquidity to sell into in those events. So we've never had an issue, and we think we can be much bigger than the $1.2 billion that we have now.
Great. We're going to go back there to Wayne and then to Jennifer. If you have a question, put your hand up now so the next mic runners can get to you, but thanks. Oh, we'll go to Jennifer. Okay, thanks.
Hi. I was just wondering with regard to small companies, I know that bigger companies in the AI space seem to dominate, and that's what's propelled a lot of the Magnificent Seven. Wondering if you can comment anything on this opportunities in small cap with AI, if there are any. And I did read a little bit about GitLab and how they might compete against Microsoft's GitHub, because it seems like the bigger one versus the smaller, David versus Goliath.
Yeah, it's okay if I take that one?
You take that one, and I'll jump in after.
Okay, I'll talk generally on AI, and then I'll let David talk about a couple of, but generally on AI, a lot of our companies actually use AI on their own proprietary data. So they're not developing chips like NVIDIA, kind of the tools to promulgate AI, but they use AI, and we think they do really well. Companies like Certara, which is a biosimulation company that simulates drugs. With regard to GitLab, it's a really interesting company. So you may know that what GitHub is Microsoft's version of helping programmers program on a collaborative basis in an enterprise. So all these programmers get together, and you got to revise something, and you got to revise it quickly and do it securely and without bugs. So that's kind of what these companies do. GitLab, which is what we own, competes with GitHub, but GitLab actually is supported by Google and Amazon as well. So you kind of have like two of the major guys against one of the major guys, and we feel pretty good. If companies that are developing software have open cloud, in other words, they're not tied down just to Microsoft, they may gravitate towards GitLab, which is what we own, because they don't want to be just tied to the Microsoft ecosystem. So there's a lot of room for these players. There's a lot of white space anyway, and the company's growing 25-30% a year, so we're pretty excited about it.
Yeah, and just to your point, one small cap name, our largest now in the portfolio is a company called Vertiv, which is benefiting from an AI proliferation in data centers. Data centers now need more rack density, and because of AI and the data that's coming in, more rack density and more racks and bigger data centers will be built, and this company, Vertiv, provides cooling equipment and power equipment to data centers. So the stock has really is up 180% this year on the basis that AI will proliferate, and they are the 30% market share leader in this space who've been doing it for 50 years. They can help their customers across the globe consult, equip, and monitor and repair all the equipment that they're going to be putting in. So they're in the catbird seat of this big wave that's coming. Now the stock has anticipated that, and the multiple has gone up from 9 times EBITDA to 14, which is appropriate for what it is. But we think we're going to grow, that company can grow 15 to 20% EBITDA as the margins expand, and the organic growth in that business, which is typically 7 to 8%, could be 15% for a very long time. So again, it's not an AI craze name, it's a real beneficiary of that movement.
Wayne, you have a question over there? And then we'll go to you, Scott.
Yeah, just a question about interest rates and if there is a concern about higher for longer and how that will impact your space.
Yeah, well, we're not economists. I have a view that I'll share, but again, our view on the specialness of Vertiv is worth more than our view on where interest rates will be. But it's my general perception that the economy is softening and that inflation is really declining. And you don't see that in the numbers, but we, as the reported numbers, as much as we hear that when we speak to the companies that we invest in and those who are interested in, which I believe truly is a better gauge of what's happening in the economy. Standardly or typically, interest rates follow the pace of the economy and the rate of growth or decline in inflation. And therefore, I was surprised this last quarter when I'm hearing that, yet interest rates, at least on the 10-year, went from 4% to 5% and kind of killed growth stocks, especially small cap growth stocks. Now what you're starting to hear is that long rates have come down a little bit on the fact that maybe we're done raising interest rates or the economy is kind of softening. My suspicion is there will be more of that and that rates will be lower in the future than they presently are. And that will be good for business, good for earnings, and good for stock multiples. Now, the negative is, and very smart people, economists and investors I respect very much, are kind of saying interest rates are going to stay higher irrespective of the pace of the economy because of concerns about the deficit or concerns about our federal government's need for capital to fund its needs to run the government. So, and I've been hearing that for 20 or 30 years in investing, but we actually are closer to a crisis situation. So, I take that with not as much of a grain of salt as I have in the past. And to me, that would be the counterbalance to the fact that the economy and inflation is shrinking. But if you watch the markets this year and watch small cap, it really is when rates go up, our stocks go down. When rates come down, our stocks go up. It's a very uncertain environment when this all settles out. And my suspicion is it will settle out with lower rates, then we'll get back to a kind of a more normal market.
Okay, question right here. Thank you.
Thanks, guys. David, this is to you. You started off by saying, how painful it's been for a 3-year bear market, and I agree with you. It's been very painful. The question I have, and Cliff kind of alluded to it just now, is what's going to be the catalyst for a better market? I mean, if you're going to say a stronger economy, you had the third quarter GDP come out at 4.9%. No idea where that number is coming from. And the fourth quarter Atlanta Fed is 2.3. Now, Cliff just mentioned lower interest rates, and we agree with him. But a lot of the reasons interest rates go lower is a weakening economy, and I don't see where that's a great scenario for you guys. So again, what's going to be the catalyst? Please tell me. I want to know.
Mm-hmm. So,
me too.
You're, with all due respect, you're talking at a macro level. We have 70 names. 60 of those names are growing. So our companies, now they may be slowing, but they're growing and doing well. And so what we're tasked to do, what you're giving, is to find those companies in their micro markets that are doing well. The Vertivs, for example, the Icons, which is a contract research organization helping biotech companies scale their clinics, their clinic trials. Guidewire, which is taking insurance companies from green screens to the cloud. These businesses are growing, and that's our job, is to find those businesses. The macro could grow 1% to 2%. Our companies typically, on average, grow 5% to 10% organic with the hopes of adding acquisitions and doing more and growing faster. So I agree with you. I'm not, the economy can go what it is, but we're really focused on the micro level and finding those niches that are growing. And Cliff and I and Randy and Laird have this open ear policy of We'll look anywhere for that growth. Any industry, which may be as banal as a packaging or whatnot, but there's growth. There's growth in certain markets.
I'll say this, the markets, I was an economics major. Markets are a discounting mechanism. And the factors that the Fed has been looking at with regard to inflation and their higher interest rate policy, one by one are knocking down, right? The housing market's dropping. And what we saw recently in the last couple of weeks is the labor market is finally starting to turn. And not for the better, as we all know. We're seeing it in individual companies that are reporting, and you're seeing it in the top line numbers, which there's a lot of back and forth on adjustments and things like that. But trend-wise, it looks like that's sort of the final pillar to fall in the overall inflation fear. If that's the case, the markets have already anticipated when you look at valuations on our individual companies across the board. And like David said, all our companies are growing. We have companies growing 100% a year. We have companies, mostly they're growing 10, 15, 20% a year. Even though the growth slowed a little bit because of the GDP overlay, the valuations reflect much worse outcomes, I think, than what's probabilistically likely given where the rate environment is and where we are in the economy. So I think the catalyst is going to be, honestly, when the Fed waves the white flag and just says we're done, or the market perceives that, stocks are going to rally. And related to what David said, our firm president, Linda Martinson, has done some work looking at the stocks coming out of these recessions, small caps, and it's only a few trading days that is most of the upside. It's like the top 5 or 10 trading days are a huge amount of the overall upside in the market. So it's kind of like, well, you can look back and wait for every signal. It's really hard to do. What we do is we're looking at great companies. The valuations are screaming at us right now. So we don't know exactly when it's going to happen, but it will.
Great. Take another question over there.
With small companies, do you look at them sometimes and make a purchase because you realize there's a high probability they'll be purchased by someone else, so to speak, that Goliath is eating up the David?
That's a factor, and standardly, we really haven't had that much M&A because of where interest rates have gone recently, but standardly, if we have a 60 or 70 stock portfolio, 3 or 4 to 5 of them are going to get bought every year by private equity or other companies. But it's kind of our rule. We don't, that's something we will consider in owning a stock, but it never is the sole reason for buying that stock because you really can't ever put your finger on if and when that's going to happen. And we'd much more want to bet on a growing business and understand its future value and bet on the company's success to make us money. And then very often somebody comes in and buys it away from you before, in anticipation of that growth. So it happens, but it's not, it can't be primary. That works out backwards.
Yeah, I would just add that essentially, if you think about it, what we're looking for, which is emerging, fast-growing, first mover, is exactly, if you're a mid or large cap company, the kind of bolt-on acquisition that you like to do. So it's not usually as part of our thesis, but it does happen quite a bit.
Our next question by Jennifer, please. Thanks.
I have two questions. One is, and this is probably the easier one, is the increase in rates having the greatest impact on your highly leveraged companies, or which companies do you see it having the greatest impact on? And then my second question is, you guys have talked a lot about small caps doing well coming out of a recession. Well, so far we're not really in one. I agree with that. Unless you would consider it, we're in kind of a rolling recession. So maybe you could speak of the way you're thinking about it with your companies. Are we actually in a recession already for those companies? And when do you see this passing and coming out of that?
I'll just take the recession question quick, but in a lot of industries, we're definitely in a recession. If you follow the semiconductor market, you've seen what's going on. You look at what's going on in kind of auto right now. I mean, auto's really never recovered back to pre-COVID SAR, average unit production. And across the board, while the GDP numbers kind of look okay, I mean, we definitely had a couple quarters that might have been negative. You know, the definition of recession is kind of technical, but feels like a recession when you talk to our companies. So
Yeah, existing home sales too.
existing home sales, yeah.
Yeah, I mean, I think, you know, I don't know how you want to define recession. I've always said economic slowdown. We're seeing it, especially in this last quarter of earnings. We saw a real step down, say, than from first quarter and second quarter of earnings.
I like to invest in companies that are appropriately leveraged, especially if they're really stable businesses, and having the proper amount of debt on them enhances equity returns. The market doesn't always agree with that, so when you get these big rate spikes, in essence, you know, sometimes the stocks fall out of bed for a little bit on, oh my God, their interest carry cost is going to go up a little bit, or they're inappropriately leveraged, which, but standardly those are short-lived, because the companies that we invest in are high-quality businesses that are properly leveraged if they have debt. The debt is relatively cheap, set in place years ago, and therefore, even if the interest cost has been creeping up a little bit, it's not going to affect their business all that much, and it really doesn't affect, you know, their outlooks that much. It might affect the stock price, which reacts maybe a little differently to change in interest rates. Higher interest rates definitely are hurting the consumer. They're hurting housing buyers. They're hurting, there are segments of the economy where higher interest rates really are taking a toll and slowing the economy down. Someone said before, how did the economy grow 5% last year? I don't know, you know, last quarter, I don't know, it's not. And so I do believe that the increase in rates from, in essence, 0 to 5% by the Fed raising rates that way really has put a damper on economic growth, which has slowed down the earnings progression of our companies, and has been a headwind to the stock market. I think we're probably close to the end of that cycle, though.
Any other questions in the audience? I see one over here. And this will probably be our last one because we have about a minute left. Yes.
Good morning. So last year, Cliff, I asked you about the initial public offering market and how that normally would impact Barron. There was no IPO market for all practical purposes in 2023. The few that have come didn't do well. What's your view of how private equity is impacting this? And do you anticipate more activity, new supply of ideas in 2024?
I would hope so. I mean, you know, the problem with the ones that came public this year, Arnie, and you're a pro at this, you know, the best companies, kind of the best, are come out first when the markets are closed for a little bit. Unfortunately, when they brought those companies to market, they're fine businesses, they were just priced very, very expensively. And people were so excited to get a new idea that they bought a stock and raced it up to a valuation that really was too high, and now you've basically had the contraction or the reality setting in that we shouldn't be chasing good companies if they're priced incorrectly. So that, to me, has been the reason why the new issue market hasn't taken hold this year. If we have a better stock market, if rates come down, I know that there's a lot of good businesses that want to come public. Private equity is really sitting on, is anxious to get liquidity in a lot of their names, and anxious to take liquidity or sell companies at reasonable prices to us, the public investors. But yeah, really, it didn't happen last year or this year. I hope it happens next year. And you're right, it's a great funnel of new ideas for us at Barron. Many of the new companies that are coming public, we see before they come public. We know we're tracking for years. We know they have the characteristics and the leadership and prospects that we're excited about. If we can buy them at good prices, we're anxious to add them to our portfolio. And I'm hopeful that next year that will be a new source of new ideas. And because that hasn't been in our flow this year, we've bought less stocks. So,
with that, I want to thank the audience for all of the great questions. Thank the panelists. Thank you.